Hello, welcome back. Cap rates, yields, and capital growth. What does it all mean? Previous episodes, we've talked about the durability of land and gold over thousands of years. And obviously people are aware that land appreciates over time. The clients that I have can be typically split into two divisions. Division one is someone wanting to buy a house or to live in, or a commercial property to operate from. And the other type of buyer is someone that's looking at real estate as an investment for capital growth and for cash flow purposes. And we do know that real estate is a great hedge against inflation. So when the economy is becoming more expensive, when our cost of goods and services become more pricey and inflationary, real estate also grows in value and becomes a great hedge when the cost of living is really high. But let's firstly talk about capital growth and what is it? Capital growth is simply the measure of the increase in market value of real estate over a period of time. If you took any block and you looked at the market value of that block or lot or site over a period of time, whether it be 10 years, 20, 30 or 40 or more, then there would be an increase in land value over time, and it would be a straight line from one dot to the other. But in reality, what's happening is the land is going up, but it's going up in a cyclical fashion, no different to the stock market. So there are years where land values actually drop, and there are years where land values go up. Overall, land goes up over time, but it does it in a cyclical fashion. So you can have periods of time where the value of that land has actually fallen. And if you look at Toorak last year and some of the areas like Balwyn and Kew and Camberwell, land's actually fallen in value in the last 12 months. So it's not always true that land goes up. It does go up in the long run, but it's not always true that land goes up. So this idea that we can just get capital growth whenever we feel like it just by simply buying land, that's not true. Also, the other fallacy is that buildings depreciate and the value of the building doesn't go up. That's not true either. Whilst a building, whether it be residential or commercial, does depreciate over time because of wear and tear, it's not actually true that a building will always fall in value. And I can give you an example. When I look at the value of real estate, what I'm always thinking is, what's the land worth? That's really critical. And when I deduct the value of the land from that real estate, what I'm left with is the value of the improvements. When you divide the value of improvements by the building area, you get the depreciated building rate. That depreciated building rate, even though the building's depreciating, it can actually be going up in value, despite what many people think. So it's not always true that land's always going up. Land can actually be falling, and it's not always true that building value is falling. Building value could actually be going up, and I'll give you an example. A good example is period style homes, Victorian terraces, Federation homes, Art Deco. A lot of these homes, even though they're over 100 years old, and one would think that the value of that building has depreciated down to zero, in fact the opposite is occurring. The value of these buildings is increasing because it's very expensive to replace them, and the older style buildings are actually more expensive than newer style. So it's not actually true that the value of the building falls and the value of the land goes up. It can actually be doing the opposite. Over a long period of time, both could be going up. So it requires due diligence. It requires someone with a good understanding of property values over time to recognize this. And what we're talking about here is market value, not accounting value. Obviously, the building depreciates over time, and for accounting purposes, after 40 years, it serves its useful life. But what we're talking about here is market value. So when we're talking about capital growth, what we're looking at is the change in value over time between the market value of the land and the improvements over that time, not just the land. Capital growth is a very important benefit that buyers get when buying real estate. And it's important to note that capital growth does not happen in a linear fashion. It happens in a cyclical fashion, and you have the land and the building both working together to create that. And by getting capital growth, it's a great hedge against inflation, and it allows buyers to be able to leverage further and to buy more real estate and build more wealth. And in addition to capital growth, yield and cap rates are really, really important. And I just want to explain the difference between the two. When we buy real estate, we're either buying the property with a lease, or we're buying the property under vacant possession without a lease, it's empty. When we buy a property with a lease, what we're getting typically is a passing rent. Now, when you determine the net rent, in other words, the passing rent less all the expenses, whether they be rates, building insurance, water, etc., you're left with a net rent, a net passing rent. If you divide that by the purchase price, that gives you your yield, your net yield. So the net yield is the net cash flow that we're getting on that property relative to the purchase price that we bought. That's all it is. And we can talk about net yield or gross yield. Gross yield meaning the total rent that we get before we've deducted expenses, and the net yield is the net rent that we get after we've deducted the expenses. So the yield is something that's related to the purchase price typically. It's what the buyer gets when they buy the property. By looking at the various yields across the marketplace, what we can determine is what causes a yield to be low and what causes a yield to be high. And typically it's related to risk. So the higher the risk, the higher the yield, the lower the risk, the lower the yield. And that's because of the risk of vacancy. So a property that's high in demand will have very low vacancy, and the yield typically is low and the price high, and the reverse is also true. So what a cap rate relates to is not only the return on the investment, but also the risk that a valuer or an agent would impose on a particular property. So there's various risks of various assets across the board, and the cap rate is how we determine that risk. So from the sales in the marketplace, we start getting metrics around yield, and the yields vary between suburbs to suburbs, between assets to assets, between residential and commercial property. But the yields in the marketplace reflect a risk return that investors are hoping to achieve. And what we start determining is a thing called capitalization rates or cap rate. So the cap rate is a metric that's applied to the value of a property by either a valuer or a real estate agent when they try and sell the property to alert the buyers that this particular property has this particular risk reward profile. So if we were to sell a factory, for example, that has a market rent of $50,000, and we would tell the buyers that the cap rate for this type of property is 5%, then we would expect a market price of $1 million in the market. If we felt, however, that the factory had a much lower risk profile, given its location, etc., then we might say that the cap rate for this type of property is closer to 4.5%. These cap rates that we assume, we're using market yields or actual sales data in the marketplace to determine what the applied cap rate is. So the beauty of real estate, not only is it a great hedge against inflation, it's great for borrowing money and building wealth, but typically we're looking for three things in all real estate purchases. We're looking for capital growth, which we've explained, and capital growth is not linear, it's cyclical, and land is principally what goes up in value, but buildings also go up in value depending on the type of building, because their depreciated value can go up. We're also looking for good return, good yield, and if a property is vacant, typically, especially with commercial properties, we use cap rate to determine their value based on their risk return. And the third thing, we're also looking for improvements. We want to be able to improve that property, whether it be through extensions, renovations, etc., or changing the use of that particular property. So there's a lot of value in having control over your asset. And one of the benefits of owning real estate, you have total control over your asset, and you can benefit from all those metrics which we've discussed on this video.